Normally, we make money when the prices go up. But guess what? What if I told you we can make money when the stock is going down as well? It's basically like buying something at a higher price and then selling it for cheaper and making money. Sounds crazy, right? Enter short selling, or short for short. If we take a look at the stock market, we can see historically that 1/3 of the time the stock market has gone down, which means we have a lot of missed opportunities if we only make money when the stock prices go up. Hence, by short selling, we have more opportunities to make money. So like when you profit from buying a stock at a lower price and selling it for a higher price, you can do the opposite with a short sale. The idea behind the short sale is that we borrow the stock from the broker and sell it. Hence, it's called short. We're short on stocks and then buying it back at a lower price, making the difference as a profit. Sounds crazy, I know. Basically, when we are in a short position, we are betting the stock is going to go down and we will be able to buy it back at a lower price. So for example, let's say we decide to short Apple and the stock is currently trading at 100 US dollars. We borrow the shares from the broker at 100 US dollars. If the stock goes down to 95 US dollars, we make the difference from 100 US dollars to 95 US dollars, which is $5 in profit. If the stock is going to go up to 110 US dollars, for example, that means we will need to cover our short and buy back the shares at that price, making us lose $10. Capish? Now I know short selling might sound a little bit complex and you might not get it 100% yet. So listen up. Let's say a friend of yours comes to you and gives you a brand new iPhone and tells you that you need to give him the iPhone back only in 1 year's time. Now, because we're savvy investors and we know that the price of the old iPhone decreases when the new iPhone comes out, we're going to sell the old iPhone right now at retail price. And then, once the new iPhone gets released, we're going to rebuy the old iPhone for a cheaper price, making the difference, and give it back to the friend, of course. So let's say we're going to sell this iPhone for 1,000 US dollars, and then when the new iPhone comes out, we're going to rebuy it at 800 US dollars, making the difference, which is 200 US dollars. The same thing applies to stock. Your friend is the broker and the iPhone is the company shares. It's basically selling something you borrowed before you need to give it back and betting the price is going to go down. It is important to note that in a short you can lose more than 100% of your money. Well, that won't happen because the broker will probably liquidate you beforehand, but theoretically you can lose more money than you can make. In a long position, we can only lose as much as we put in the stock, and the upside, well, there is no end to the upside basically, but in a short position we can lose more money and the upside is only limited to 99%. Short selling can be tricky, so it's important to fully understand it before trying it. It's not for beginners, but it's a useful strategy for experienced traders.